Welcome to The Explainer. Today, we're diving into the story of a company that posted a loss so catastrophic it looked like the end. But what if that was all part of the plan? So, let's set the stage. In 2024, a major Japanese tech firm, JSR, drops a bombshell, a net loss of over 217 billion yen. I mean, on paper, this looks like an absolute disaster. Now, to figure out just how bad this is, analysts have this tool called the Altman Z-score. You can think of it as a kind of financial EKG for a company, predicting the odds it'll go bankrupt in the next couple of years. And JSR's score? Well, it didn't just dip, it completely cratered to negative 0.1315. To give you some perspective, anything below 1.81 is a serious red flag. JSR was so deep in the distress zone, the numbers were basically screaming that failure was imminent. And that brings us to the real mystery here. Was one of Japan's most important tech companies, a company that's absolutely critical to the global supply chain, really about to just go under? The financials were yelling yes, but there's way more to this story. Okay, so the first clue that something really strange was going on here came from a pretty unexpected place. Right when things looked their absolute worst, a massive new investor showed up. And this wasn't just any investor. It was JIC, Japan's powerful government-backed investment fund. While everyone else was looking at these disastrous numbers, JIC just swooped right in and spent billions to buy out all the shareholders and take JSR off the public stock market entirely. And what they said publicly pretty much reveals the whole game. They weren't buying a company that was failing, they were buying it time. See, by taking JSR private, they were giving it the breathing room it needed to do a massive overhaul, far away from the constant pressure of hitting those quarterly profit targets for Wall Street. But hold on, that raises a huge question, right? Why on earth would a rescue plan start with a financial report that looks like it was designed to scare everybody away? Well, it turns out that was the whole point. To really get what happened, we've got to look at the accounting. Because what we're seeing here isn't a crisis. It was a carefully planned, controlled demolition. The key here is a strategy that people in finance call a big bath. It's when new management, or in this case, a new owner, decides to take all the possible financial hits they can all at once. Yeah, it makes the current year look absolutely terrible, but it completely cleans the slate for a much healthier, more honest start going forward. It's like ripping off the Band-Aid. And believe me, JSR took a massive bath. They booked what's called an impairment loss of almost 158 billion yen. They were basically just saying, you know what, a bunch of our assets aren't actually worth what we've been saying they are. Now, here's the most important part. These were non-cash losses. No actual money walked out the door. JSR was just admitting something they already knew. And these write-downs, they were almost all concentrated in one specific area, their life sciences division, which had been struggling. And you don't have to guess at their intentions. The CEO said it himself. This was a deliberate choice. It was about surgically cutting away the parts of the business that weren't working, to pour all their energy and money into what they do best. So this whole big bath thing, it wasn't just about cleaning up the books. It was about clearing the entire deck for a huge, dramatic pivot towards the most important technology in the world right now. What we're seeing is a total transformation. The old JSR was a diversified company, trying to juggle a few different things. The new JSR, it's becoming a laser-focused specialist, betting its entire future on making super advanced materials for the semiconductor industry. They are literally shedding those life science divisions, the very same ones they just took those huge write-downs on, and are now pouring every resource they have into one single critical area, creating the unbelievably advanced materials you need to make the next generation of AI chips. So now that the smoke has cleared and the so-called crisis is over, what does this new, leaner, more focused JSR actually look like? And, what are the risks of making such a bold bet? Well, the results are already starting to show. After that massive engineered loss, the company's core profitability, we're talking earnings before interest and taxes, it swung dramatically from deep in the red back into the black. And that happened in just 6 months. The strategy is paying off. If we do a quick breakdown, you can see the new landscape. JSR's strengths are huge. They're a world leader in things like EUV photoresists. That's a vital ingredient for the world's most advanced chips. And now they've got the Japanese government in their corner. The opportunity? The insane AI boom. But there are real risks too, like the high debt they took on to go private, and of course, all the geopolitical tension around technology. And to go with this bold new strategy, they've set an equally bold target, a core operating profit of 100 billion yen by 2030. And that growth is expected to come almost entirely from the world's unending demand for more and more powerful computer chips. So it really leaves you with the fascinating question. The story of JSR shows that sometimes what looks like a total catastrophe on a spreadsheet is actually the first step in a brilliant and powerful strategic rebirth.